Big Kev's back with another lighting lesson for IB Economics. Last lesson we talked about price controls. This time we're talking about a much more subtle way to influence production and consumption. Let's go. First up, indirect taxes. These are taxes on spending. Think sales tax, excise tax, or VAT. When the government slaps a tax on a product, the cost of production goes up. That shifts the supply curve left, raising prices for consumers and cutting quantity demanded. It is said that indirect taxes drive a wedge between producers and consumers. The consumers pay a higher price, but the producers receive a lower price. The difference goes to the government, but results in a welfare loss. So what does this mean for stakeholders? Consumers lose because they pay a higher price and buy less. Suppliers also lose because they receive a lower price and produce less. Workers then also lose because of the decrease in production. The government is the only winner here as they collect the tax revenue, which is an increase to their budget. How about society? They lose too, even though the tax paid comes back to them in the form of government spending. But since the market can't get to allocative efficiency at the equilibrium point, we have an underallocation of resources going toward the production of the good, resulting in a loss of social surplus represented by this triangle. Now let's flip it and talk about subsidies, which are basically the opposite of indirect taxes. A subsidy is when the government pays part of the cost for producers or consumers. It's basically financial support to boost production or make goods cheaper. The supply curve shifts right, prices drop, and output increases. The subsidy causes an artificially low price and low cost of production. This means that the consumer will buy more than they would, and the supplier will produce more than they would. This means overproduction and a welfare loss. Let's look at the effects on stakeholders. Consumers win because they can buy more at lower prices. Suppliers win because they can receive higher prices and produce more. Workers then also win because more production means more jobs. But the government loses because they're the ones that are paying for it all. How about society? Sounds great, but believe it or not, society loses. While there are gains in both consumer and producer surpluses, we can see this triangle here represents the welfare loss to society, since there is an overallocation of resources going toward the production of the good. This is a waste, since at the actual price, the consumer would not buy as much and suppliers would not produce as much. And for the HL students, you need to be able to do the calculations. For that, you'll need to click the link to see the explanation in the full lesson. I only have 3 minutes for YouTube Shorts, so I can't explain everything here, but I do in the full lesson. So watch that and make sure you know how to calculate the amount of tax or subsidy per unit, amount of government revenue or expenditure, and the changes to social surplus. And done! Big Kev out!